Hey there, awesome accounting student. Mark Franke here. This is a video for Accounting 102, Chapter 20. We're going to do a master plan. This is a plan that will go from start to finish. This is problem 20-4B, which is in your book on page 814. So the way the planning process works in a business is we're basically just going to go through the income statement, starting at the top with sales. Customers, who are they? What are their needs? How do we supply those needs? And then after we know what sales is, we have to start with sales, and then we can base it based on sales. How many units do we need to produce? What's the three product costs, the materials, labor, and overhead that we'll need to provide those customers with the products. And then below gross profit, we'll look at sales, selling expenses, administrative expenses, interest expense, and then we will build a cash plan or budget, and then a set of financial statements, income statement, statement of equity, and a balance sheet. So this whole process can obviously be very complicated. This is a company that has one product, and it's going to be, fairly comprehensive in and of itself. But the point is, this is what we would call a master plan. We're going to plan for 3 months ended September 30 of 2020. So what we have to start with, again, is sales. This is based on, and what the book has done is they provided you with a June 30, 19, I've changed it to 20, that's fine, an estimated balance sheet at the end of June. So we're planning the months of July, August, and September. In other words, they're doing this probably in June. They've done an estimated June balance sheet. That's the starting point, and then we're going to be planning into the future, July, August, September, based on the assumptions that they've given you on page 814, starting with the assumptions for sales. So they sell their product for $17 a unit. They've given us the information for July, August, and September, and we just literally multiply it out. Very easy. If we had multiple products or regions or whatever, then we would deal with that. Now, I've already prepared the solution to this problem, so it's just going to save me having to type. And by the way, there are some worksheets that I provided in Canvas that you can use to follow along. So second step is to do a production plan. And they've told us that they want to be able to have some inventory available at the end of the month. 70% of their sales for the following month needs to be on hand so that they can ship it automatically to the customer. So for July production, we're going to use the August sales. And August sales is 19,000 units. We multiply that times 70%. That tells us we want to have an ending inventory of 13,300. We plan to sell 21,000 during the month of July, which means we need a requirement of 34,300. But we had a beginning inventory of 16,800. So we need to produce 17,500. This is a very common thing where we're taking the next month's sales, because we don't want to end the month with nothing on the shelf, because then customers that buy stuff at the beginning of the month, we wouldn't have any inventory to sell them. So that's the purpose of this schedule, is really just to plan the production for the next 3 months. July, we're going to make 17,500 units. August, we're going to make 19,700 units, and September we're going to make 22,800 units. So the total number of units for the quarter will be 60,000, and that's how many we're going to sell. That's a coincidence. I mean, it is what it is, but just so you know. Okay, so now we know that we are going to produce 17,500 for July, 19,700 for August, and 22,800 for September. We can do a materials plan, and actually the materials plan for this one is on the top of page 2, or the worksheet number 2. And we are literally taking the production numbers that we just calculated in our production plan and then scheduling out how much we'll need in raw materials. We only use one material for our one product, and we use a half of a unit. Let's see, we use a half of a pound or whatever it is per unit. So that means for 17,500 units, we need 8750 pounds or units, whatever it is the raw material is, of 8750. We also have some estimated ending inventory of 1970. They gave that to you. So the raw materials required will be 10,720. And I'm sorry, the 1970 is actually what we want to have on hand at the end of the month. We don't want to run out of raw materials, so we're going to take what we want to have available at the end of August, available at the end of July. 1970 units of the raw material needs to be available to produce our products in August. But we have beginning inventory of 4375. That was sitting on the shelf in our raw materials warehouse at the beginning of the month. So what we have to buy is 6,345 units. We pay $8 a pound or a unit for this material. So we're going to spend 50,760. And we're just going to do the exact same calculations for August and September. So the total amount of raw materials that we will plan to purchase for this 3-month period is 220,840. Then we can do our labor plan. And it really doesn't matter if you do the raw materials before the labor, but I usually do raw materials before labor, but it doesn't really matter. Same concept here, except now we're talking about direct labor. Direct labor, we're taking our budgeted production, we're multiplying it times the number of hours that it takes. And in this case, just like the raw materials, it takes a half an hour to make one of these. So that means we're going to need 8,750 hours times the $16 labor rate gives us our total labor cost for July of 140,000, August 157,600, and September 182,400. Next, we will then do our overhead plan. And the overhead plan is going to be based on labor hours. That's our application rate. Our overhead application rate is $2.70 per direct labor hour. So if we just take the planned labor hours, multiply it times our rate, that gives us our variable. That's our variable overhead. And then we have $20,000 worth of fixed overhead, and that's all depreciation of equipment. We could have other overhead items, but again, because this is a fairly simple model, we only have one overhead item in that's fixed, and that's $20,000 of depreciation. Now, keep in mind, we'll need that information when we go to prepare our balance sheet. So the total planned overhead for July is $43,625, and the total for the 3 months is $141. So we've gone sales, then our 3 product costs, materials, labor, and overhead, and now we can look at the selling and administrative expenses. The selling expense plan, we have some sales commissions at 10%. So we're going to bring the sales from our sales budget, sales plan, and multiply it times 10%. So our sales people get a 10% commission on everything they sell. So for July, the sales commission would be $35,700. We also have a sales manager that gets $3,500 a month. So the total selling expenses for July, $39,200, which is a total of $112,500 for the 3 months. Then we have our G&A expense or administrative expense. We have some salaries. These are fixed. We also have some interest on a long-term note. Now, typically we wouldn't put interest in with administrative expense plan, but they've told us to do this in this particular problem, again, just to make it easier. We have a $300,000 long-term note that has interest per month of 0.9%. So that's $2,700 each month. Our total expense for administrative is $11,700 for all 3 months during this planning period. Then we have to do a cash plan. So the cash plan, and I'm going to make this a little bigger so it's easier to see. What we're doing is we're just trying to plan out our cash flow. So the cash flow is the cash that came in from customers and then the cash that went out to vendors and employees for all the things that we needed to buy. So if we start the month and we've got that $40,000, we start the month with $40,000. That comes from the balance sheet that's in your book. So the ending balance in June was the beginning balance in July. And then when we're done with July, that beginning balance or that ending balance in July will become the beginning balance in August. And then the ending balance in August will become the beginning balance in September. So we have to do this one month at a time, and you can follow these numbers. But what they've told us is that credit sales is 70% of total sales. So we have to first figure out how much cash are we going to get from sales, and that's 30% of the sales. And then how much are we going to collect from our receivable customers, our non-cash customers. And they've said that there's a 1 month time lag. So whatever was in accounts receivable at the end of June, again, right from the balance sheet, $249,900 is the amount we've collected in July. In other words, whatever is in receivables at the end of June, we collected in July. So there's a 30-day lag time with our customers. It makes sense if our terms are net 30. So the total cash we received from our customers, $357,000, add that to the $40,000, and our cash available is $397,000. Then we need to schedule out the disbursements. How much are we paying for raw materials, for direct labor, for the variable overhead, for sales commissions? Now remember, the variable overhead is the cash part of it. The other part of overhead was depreciation. There's no cash involved in depreciation. That's why that doesn't show up here. Then we're going to pay the sales commissions. We're going to pay the sales salaries for the manager. We're going to also pay $9,000 for administrative salaries. We also had our $2,700 a month of interest on our long-term loan. And we have a short-term loan that we have to also pay interest on. That's interest at 1% per month. So for the month of July is $240. So our total cash payments or disbursements is $276,165. And when we subtract that from the cash that was available, and I'll make this a little smaller so you can see it, there's the cash available. The $397 minus the $276 means that we have cash that we're estimating to be $120,835. So now we can pay off that $24,000 short-term loan. In other words, we have a line of credit with the bank that when we need cash, we can borrow, and when we have excess cash, we can pay it down. And that's what's happening here. We have $120,000 available. So after all of our expenses are paid, we're going to go ahead and pay off that loan, that short-term line of credit, which means our ending balance is going to be $96,835. And what I've shown down below here is that now we don't have a balance in that long-term bank or short-term bank loan because it's paid off. That's the $24,000. So that $96,835 becomes the August beginning balance. We go through the same process again, 70% credit sales, 30% cash sales. You can see that the credit sales from July, $249,900, became what we collected in August because there's a 30-day lag time. So our customers that we received, the amount we received from our customers, $346,800. The cash available, $443,635. Then we have our disbursements for the month of August. For raw materials, labor, variable overhead, sales commissions, sales salaries, administrative salaries, and dividends. They told us they're going to pay some dividends in the month of August. That's $20,000. So our total cash payments is $302,455. And our bank balance before, or cash balance before any bank loans, and we don't have any bank loans now, or any short-term bank loans. So that $141,180 is going to flow right through to the beginning of September. And then in September, again, we go through total sales, 70% credit, 30% cash. The cash gets added, the cash sales gets added to the previous credit sales. And August credit sales were $226,100. So now we're going to add that in to get total cash received from customers of $328,100 and cash available is $469,280. Then we schedule out our payment for raw materials, direct labor, variable overhead, sales commissions, sales salaries, administrative salaries, just like we did for the other 2 months. And this month we have a special payment for buying some equipment. We bought some equipment in September. We had to pay $100,000 for it. And so that's being shown there in our disbursements. So our total disbursements are $443,000. The cash available is $469,000, which means that after all of that, we will have a $25,620 in our bank cash account. But they've told us they don't want to go below $40,000. So that means we're going to have to borrow $14,300 from the bank in order to get our balance to be $40,000. And down below, we've got the ending short-term bank loan balance of $14,380. This is a number crunch, and this is something that you'll need to spend a little time with. I would suggest that you write one out from the work papers I provided. So now we're ready to do our income statement. We could do a monthly income statement. They didn't ask for that, so we're just going to do it for the whole quarter, taking our sales information, taking our cost of goods sold. We sold 60,000 units at $14.35. That means our gross profit is $159. We get our sales, G&A salaries, long-term interest on the note, and then the short-term interest that came from our cash plan. So our total expenses, $147,840. This is on an accrual basis. This also includes now everything that we went through. So our income before taxes is $11,160. When we subtract that from the $159 gross profit, we have income tax expense of 35%, which is $39.06. Net income is $72.54. From there, we can prepare a statement of retained earnings. We get our beginning retained earnings from the book, $60,580. We're going to add net income, $72.54, subtract the dividends, $20,000, again from the cash plan, and we get an ending balance in retained earnings of $47,834. And then the last step of this process is to prepare an estimated or a pro forma or a prospective balance sheet, where we're literally taking all of the things that we have done in this plan and scheduling it out. So I'm going to make it so that you can see the whole thing on one sheet. Again, starting at the top, we've got cash comes from the cash plan. Accounts receivable is going to come from the schedule of accounts receivable. We're doing what's called a roll forward, taking the beginning balance, adding the credit sales, subtracting the collections, and our ending balance is $238. You'll also notice that $238 is the amount of credit sales in the month of September because there's a 30-day time lag. Then we roll forward raw materials inventory. We started with a beginning balance of $35,000. We bought $228.40. We used $240, so our ending balance in raw materials inventory is $15,840. Finished goods didn't change because what we produced, 60,000 units, and what we sold, 60,000 units, is exactly the same. So our finished goods inventory from June is going to be the same finished goods inventory in September. Total current assets, $534,920. We had equipment of $720. We spent $100,000 on some new equipment. So now our equipment balance is $820. This is schedule marked with a D. We also had $240,000 in accumulated depreciation at the beginning of the quarter, the end of June. And during the quarter, we charged another $60,000 in depreciation expense. So when we add that all up, we get total assets of $1,054,920. Now we look at the liabilities and equity side. Accounts payable is Schedule F. We started with $51,400. We purchased $228.40. The only payables that we have is for purchases of raw materials. We made payments of $183,440. So our ending balance is $88,800. We have a bank loan. That's the short-term bank loan. That comes from the cash plan, $14,380. And then we also owe some tax, $39,06. That's a tax payable from the income statement that we accrued based on the 35% tax rate. So our total current liabilities, $107,086. We still have a $300,000 long-term note payable. That didn't change from June. And then we have common stock of $600,000, didn't change. We have retained earnings of $47,834. That comes from the statement of retained earnings. We total it up, $647,834, add it to the liabilities, and we get a balance sheet that has total liabilities and equity of $1,054,920, and our balance sheet balances. I know it seems complicated, but it's like a puzzle. All the pieces will fit together if you do it in meticulous form. You've got this one as an example. I would prepare these schedules out and submit them for credit on this video, but the most important thing is the practice. You need to practice this just to get a feel for how this flows, and then you can attack problem 20-4A. Okay, that's it for this one. I'll be available to help if you need. Reach out to me, and I'll see you again soon.